Welcome to yet another session, and on behalf of Manifested Publishers, I wish to welcome you again. My names are Mr. Mariga. I'll be teaching Advanced Management Accounting, and today I want us to continue with the topic that we had previously introduced of applications of marginal costing. During the last session, we talked about one other application of marginal costing, which is non-routine, decision, specifically limiting factor. Today, we want to talk about another routine decision, a non-routine decision referred to as throughput accounting, accounting. And I want us to do a question of April 2022, question 2A. 2A, part 2. The company name is known as Zinc Limited. The company name is known as Zinc Limited. But maybe before we do this question, let me explain this concept of throughput. Now, throughput simply is a method which assumes that variable cost will be made up of only direct materials. Okay? Under normal circumstances, or in the previous sessions and also in your intermediate level, variable costs have been made up of what? Direct materials, direct labor, direct expenses, and your other variable what? Costs. But now, using throughput accounting, the assumption here is that the only costs that are variable will be what? Direct material. So the other costs, such as direct labor, such as direct expenses, such as variable overheads, will not form part of variable cost. Instead, you are to write it off in the income statement as fixed cost. Instead, you're going to treat them as fixed cost, So now that that is clear, we can now read this particular question, question 2A. Zinc Limited is a manufacturer of 3 products, namely XYZ. The management of the company is unhappy with the current production mix and is seeking to advise on the most optimal arrangement. The current production is 10,000 units of X, 5,000 units of Y, and 6,000 units of Z. The management accountant has provided the following information relating to the 3 products. You have a selling price per unit of 1,200, 2,000, and 2,250, material cost of 300, 900, and 600, overhead cost that is variable of 150, 400, and 450. Each type of the product passes through 3 departments in which a different type of labor is used. The labor requirements in each department are given below. You have your department, your rate per hour, your labor requirements per unit. Department 1, your rate per hour is 20, X is 3 hours, Y is 4 hours, Z is 6 hours per unit. Department 2, the rate per hour is 40, X you're using 1 hour per unit, Y 2.5 hours per unit, and Z 4 hours per unit. Department 3, the rate is 30 shillings per hour, X is 5 hours per unit, Y 7 hours per unit, and Z 9 hours per unit. There is a shortage of labor in Department 2, and it is not possible to increase labor input hours beyond the level currently utilized. Fixed overheads are budgeted at 5 million per annum and are expected to remain constant. A recent survey disclosed that the maximum sales potential for the company is 12,500 units of X, 7,500 units of Y, and 8,000 units of Z. Advise the management of Zinc Limited on the most profitable production mix and the optimal profit using what? Throughput accounting. Now, our available labor hours, available labor hours here. They're saying that there is a shortage of labor in department 2 and it is not possible to increase labor input hours beyond the current what level. Okay, so X, this is department 2. For you to produce a single unit of X, you require how many hours per unit? 3. And you are producing how many units? The budgeted production was 10,000. So you need 30,000 hours. Y, how much here? And this is 1 hour. This should be 1 hour in department 2. That is 1 hour in department 2, not 3 hours as previously indicated. So that is 1 hour in department 2. Then department 2 for Y, you're using 2.5 hours. You multiply by a budgeted production of 5,000. Z, 4 by who? 6,000. So that will be 24,000 hours. Then the product of 2.5 hours is 12,500. So for you to produce all your output, you need 46,500. 46,500. Then have your required labor hours still in department 2. X, we are determining this so that we can determine our limiting factor, so that we can see how much is scarce in this particular company. You require 1, 2, and 4, but your maximum sales demand is 12,500. Y is 7,500, and Z is 8,000. So that is 12,500. That is 15,000, and that should be 32,000. So for you to meet all your production needs and your maximum demand, you require how many labor hours? 59,500. 59,500. Therefore, you have a shortage or a deficit of how much? 46,500 minus 59,500. That means you have a deficit of 13,000. A deficit, why? Because what you require is far much more than what is available. That is the first thing you do. Then the next item now is to determine our throughput. Our throughput cost per unit. Cost per unit. That is the second step. The first step here is to get our deficit. This is step number 1. So the second step is to get to determine our throughput cost per unit. And your throughput cost per unit, you're simply going to take your what? Your selling price, you subtract all your what? All your material cost. So it will be the selling price per unit, subtract all your direct materials. His selling price per unit is 1200. Y is 2000 and Z is 2250. You less your material cost. Remember, we've said using throughput accounting, the material cost is the only cost that is assumed to be what? Variable. The only cost assumed to be variable. So your material cost is 300, 900, and lastly 600. So that this will give you what? Throughput cost per who? Per unit. Cost per who? Per unit. That is 900. That is 1100. That must be 1650. 900. Wonderful. Once we've done that, step number 3 is we determine your throughput cost per unit per limiting factor or per scarce what? Resource. Per limiting factor or per scarce resource. And how will you do that? You're going to determine that by taking your throughput cost per unit. You divide by your limiting factor per unit. You divide by your limiting factor per who? Unit. X, Y, and who? Z. Your throughput cost per unit that is 900, that is 1100, and that is who? 1650. That is 1650. You want to divide that by your limiting factor. And remember, your limiting factor is said is a scarce what? Resource. So your limiting factor is a factor that gave us a what? A deficit or a what? Shortage there. And what was it? The shortage was given by your labor hours. The labor hours per unit. And here, X, you are using 1 hour, Y, 2 hours, and Z, 4 hours per unit. So therefore, your throughput cost per unit, per labor hour per unit, that will be 900. That is divided by 2. It's 550. 1650 divided by what? 4 is for 12.2.5. For 12.5. The fourth step is to determine your rank. And the rank here, you're normally going to use, or is going to be based on the highest throughput cost per limiting factor. So here, it is based on the highest per who? Per unit. per unit, which is step number what? Which is step number 3, yeah? So here you have X, you have Y, and you have who? Z. Your throughput cost per limiting factor is per labor hour per unit. Per labor hour per unit. Here you'll have X, you'll have Y, and you will have who? Z. As per step number 3, that was 900, that was 550, and that lastly, that was 412.5. Then you now introduce your who? Ranks. And the first product you want to rank number 1 is XY. It has the highest throughput per labor hour per unit. Then product 2, and lastly product what? Z, product XYZ. Step number 4 is you determine your optimal output. You determine your optimal output. This optimal output will be the one to maximize your throughput cost per unit. So here you must have your product, your available labor hours, because that was the limiting factor. Compare this with the required labor hours. Then determine your who? Output in units. Determine your output in what? Output in units. According to the rank we've just determined in step 4 above, the first product we want to produce is X. So let us produce X as our first product to produce. Our available labor hours as per our working in the first part of the question was 46,500. Those are the total available labor hours. And for you to produce X, you require how many labor hours? 10,000 labor hours. So to determine your output, you're going to take your required labor hours of 10,000. Then you divide this by the hours per unit of X in department 2, where you are using how many units? Hours per unit? 1. So therefore, you're going to produce how many units? 10,000 units. The next product according to our rank is produce product Y, where you now will determine your available labor hours after producing what? X, by taking 46,500 hours, but to produce X you've used how many hours? 10,000. That means how many hours are remaining? 36,500. 36,500. The required hours to produce Y were 12,500. 12,500. So we then need to determine our who? Output. How is that? We are going to determine it. You are going to determine 12,500. Then you divide that by the hours per unit that Y is using is department 2, which is how many hours? 2.5. 2.5. And therefore, you will need to produce how many units? 5,000 units of which product? Of Y. Let's produce product Z. Let's produce product Z as the last product. You have produced 5,000 units of Y and used how many hours? 12,500 out of a possible how many hours that are available? 36,500. That means the new available labor hours that you're going to use to produce who? Product Z will be 24,000 labor hours, which is 36,500 minus the required hours that you used of 12,500, 24,000. You require Z 32,000, but you don't have 32,000 available labor hours. You only have 24,000 available labor hours, and that is what you're going to use. Then let's get our output. You're simply going to take 24,000 labor hours. You divide by the labor hours per unit of what? Z. And the labor hours per unit of Z is 4. So that is 6,000 units. 6,000 what? Units. 6,000 units. Let's then determine our optimal what? Profits. We need to determine our optimal profit. I will work this optimal profit in this other end. They were asking us to determine our output and our optimal what? Profits. Now, let's start with our sales. We will have for which product? X, for Y, and lastly for who? Z. The units of X, or the selling price is 1,200, but how much were you selling of X? You are producing and selling 10,000. Y is 2,000. By how much? You are producing and selling 5,000 units. Z 6,000. Your selling price rather is 2,250. You multiply by how much? 6,000 units. 6,000 units. Then we less our direct materials. Our direct material cost, which we've said when you're using throughput accounting, always treat the material cost as a variable what? Cost. Therefore, it is going to change with your who? Output. So the material cost that we want to determine here will be for this optimal output. For this optimal output. You can start with X, Y, and who? Z. The material cost per unit of X is 300, Y is 900, and Z is 600. You multiply your optimal output of 10,000 units, which is this 10,000. Y is 5,000, and Z is 6,000 units. That will give you your throughput what? Cost. That will give you your throughput what? Income. Then we need to less our other. But these other costs, all of them are going to be treated as what? Fixed costs. They are going to be treated as fixed cost. Therefore, when you're determining these other costs, you're not going to multiply them by the optimal output when they have been given the cost per unit. Instead, you're going to be multiplying them by the budgeted output. You're going to be multiplying by the budgeted output. You can start with which cost? Variable overheads. The variable overheads of X, Y, and Z, they were given per unit basis, so therefore you are going to multiply by your current budgeted production. The cost per unit of X is 150. By your current budgeted production of how much? 10,000. Y plus fixed cost. Y 400. by a budgeted production of who? 5,000. Z 450 by who? 6,000 by 6,000. That is variable what? Overheads. The other cost must be the cost of direct labor. Direct labor. Direct labor. And your labor cost here can say for department X or departments. You have in departments. You will have in departments. So in department 1, can start with who? X. Can start with X, and X you are using 3 hours per unit. Then you multiply by your budgeted production of 10,000 plus so for X will be 3 hours times budgeted production of 10,000 plus Y is 4 hours by a budgeted production of 5,000 plus Z, the hours per unit are 6 hours by your budgeted production of how many units? 6,000 hours. Once you've determined your labor hours, you then multiply by your labor rate per hour of how much? 20. You multiply by your labor rate per hour of 20. So this will just give you the product of the labor hours. Let's go to department 2. Department 2. Department 2, X, you are using an hour times budgeted production of 10,000. Y, you are using 2.5 hours by a budgeted production of 5,000. Z, you are using 4 hours times budgeted production of 6,000. But in department 2, the rate per hour is how much? 40. Department 3, you are using 5 hours per unit, but your budgeted production was 10,000 for X. Y, you are using 7 hours by budgeted production of 5,000. Z, 9 hours times who? Times 6,000. Then all that you multiply by a rate per hour of how much? 30. Then the other cost, those are the other costs here. So the last cost is your fixed cost. Your fixed costs. And your fixed cost was given by note number 3. Fixed overheads are budgeted at 5 million per annum. 5 fixed overhead costs. Of what? 5 million. Then we are going to determine a net profits or what? Loss. Your net profit or loss. And let's do that. Let's do that. We want to get the product, our profit rather. Our profit using the throughput costing. The throughput income will be 2.44 million. $2.44 million. 150 by 10,000, that is 1.5. That is 2 million. That is 2.7 million. $30,000 plus 20,000 plus 36,000 means you have used 86,000 hours by 20, that is 20,000. 10,000 hours of X plus the hours of Y plus the hours of Z you have used 46,500, but each hour is being paid at 40, so that is 60,000. 50,000 hours, which is 5 by 10 plus 35,000 hours plus 54, that is 139,000 hours by 30. Obviously by hours on that variable overhead. The variable overhead is 6.2 million 750,000. So therefore your profit or loss will be 545, then confirm. This is okay. $45,50,000. All right. So the main difference between what throughput accounting and what limiting factor is simply the treatment of what, or the determination of what throughput, cost per unit here. The determination of throughput cost per unit. Under throughput accounting, you must determine your throughput by taking your selling price minus your direct material cost. But with limiting factor, you normally take your selling price, you subtract all the variable cost, Remember, in throughput accounting, we've said all other costs that are not what? Direct materials, you will tend to treat them like fixed cost. You will tend to treat them like fixed what? Fixed cost, like fixed costs. All right. We have come to the end of that subtopic known as throughput accounting, and in the next lesson we are going to do drop or continue decisions. Goodbye.